Do you ever feel like you're working hard and your money just seems to disappear? Like, no matter how much you earn, there's just nothing left at the end of the month. It's frustrating, right? Well, you're not alone. I was in the same boat. And it's because we were just never taught what finance was or financial basics when we were growing up. And in fact, over 60% of adults wish they had more financial education. And that's because school taught us algebra and Shakespeare and not how to handle a credit card or manage an emergency fund. That stops today because in this video, I'm gonna walk you through 5 personal finance basics that you wish you'd learned years ago. And stick around to the end because I'm gonna share one hack that makes saving and spending way easier. Most people miss this. All right, let's get into it. Basic number 1 is budgeting and basics around budgeting. First of all, everybody needs a budget. The first and most important thing when thinking about personal finance is you have to know what your inputs are and what your outputs are. And if your output is bigger than your input, you have a huge problem, and that is number 1 thing that you have to fix right now. Most people think budgeting is restrictive, that it forces them to be so careful and thoughtful about what they're spending it on. It's frustrating for them. But it can actually be really freeing. And you don't have to know down to the penny every single thing you're spending your money on, but you really do need to understand broadly what are the main categories you're spending it on and what percentage of your income are you spending on these categories. Understanding your budget just to this level of detail will help you understand if there's any major problems with how you're spending your money. Are you spending way too much money on a car, or are you spending way too much going out to eat? If you haven't ever sat down and taken the time to see where your money is going, then it's really hard to just know intuitively what this is. Now here's an example spend report from Chase. Notice how it automatically categorizes your spend for you, so you don't have to go line by line, wasting your time categorizing everything. And typically every major bank or credit card will have some sort of spend tracker or spend report like this. So make sure, no matter what you're using, find it. And this is step 1 to really understanding where your money's going. Now that you have a broad idea of where your money is coming from and what you're spending it on, put together a budget. And a really helpful starter budget plan is called the 50-30-20 rule. And what that means is 50% of your income is spent on needs, 30% on wants, and 20% on saving and investment and yourself for the future. And there are lots of tools to help you with this 50-30-20 budget. I've got one here pulled up from NerdWallet that I'll link below. And it's really simple. Just plug in your after-tax income. So this is really important. Whatever's hitting your bank account, plug in here per month, and then it'll pop out needs, wants, and savings and debt repayment. So use this. Also, 50-30-20%. It's pretty easy to do the math on your own. Don't necessarily need a calculator if you don't want to. Now, one really important pro tip here as you're getting your budget started, if any of your spending is just way out of whack in some of these categories, right? You just have monstrous spend on a car or whatever else, make sure you get that handled first and then eventually get to this 50-30-20 budget in the long run. Now for personal finance basic number 2, and that is building an emergency fund. And think of an emergency fund as a stress reliever or a emergency backstop so that you don't have to spiral into all sorts of bad debt if you ever need to dip into this fund. And the best place to keep this is in a high yield savings account, something that will accrue a good amount of interest while you're not using it, which hopefully is very, very rarely, and will continue to grow over time, outpacing inflation. Now let's talk about a very important question of how much money do you personally need in your emergency fund? Obviously, this is going to vary extremely from person to person and situation to situation, but here's some great tips from Dave Ramsey on his website. And really his tips are either a 3-month or a 6-month emergency fund, depending on your personal situation. I tend to agree with this. This is actually pretty good advice. And really my rule of thumb that I take for myself personally is if I suddenly lost my job and had no income for anywhere from 3 to 6 months, I want to have a comfortable emergency fund to handle all of my normal expenses. Obviously you cut out some unnecessary spending, but car, any sort of debts, mortgage, food, all those regular expenses you need every month to pay no matter what happens. You want to make sure you have that emergency fund there for you when you need it. Now, there are tons of ways to build up an emergency fund if you don't have it yet. I suggest breaking it into manageable chunks, a couple $100s a month, or a certain percentage off of your paycheck as it's coming in will slowly help help you build it up to where you need it to be. And then don't forget to put that money into a nice high yield savings account where you're getting 3, 4, 5% interest a year so that you're not losing all of that money to inflation over time. So every kind of debt or loan can broadly be put into one of two categories: good debt and bad debt. The best way to think about it is good debt is helping you build your net worth over time, and bad debt are things that are taking away from that. And some good examples of those two categories: good debt would be a mortgage, right? You're eventually paying down that mortgage, your home is generally appreciating, so that asset is becoming more valuable over time. Something that would be bad debt would be like credit card loans, something you just overspent, you're getting charged an obscene amount of money, and when you pay it off, there's nothing there for you, there's no asset that you're building towards. Bit of a pro tip here, a lot of people don't really know, auto loans and cars are typically bad debt because for the most part, cars are depreciating assets, so even as you're paying them down, that asset is becoming less and less valuable over time. Now, another really, really important point I wanna make here is that debt is not all bad necessarily. Good debt is generally good, and those are things that you want to have because they're beneficial to you in the long run. Regardless, when you're thinking about paying down debts, obviously you want to be focusing on the bad debts, but really a good rule of thumb is any loan or debt that you have that is accruing more than 8% interest a year is something you really want to look at very closely and work to pay those off as fast as you can. Now, there are tons of great tools out there and strategies for how to pay off debt. Dave Ramsey is probably the icon for paying down debt and how that works. So generally his method is the snowball, which is start with the smallest loan that you have, regardless of what the interest rate is, and start paying that off so you can get a moral victory. Honestly, that's not the best solution for most people. Most appropriate solution for most people is going to be more what's known as an avalanche solution. And that's going to be looking at which debts have the highest interest rates, which is typically going to be credit card debt. So if you have 20 to 25% credit card debt, that's the things that you want to target first, no matter how big the balance is on there, because the interest they're accruing is pretty enormous. And just to illustrate what that looks like here, so I'm showing you on Credit Karma here this debt repayment calculator. So if I can pay $500 a month and I owe $20,000 at an 8% interest rate, so something reasonable, maybe this is a student loan, you can look here, my monthly estimated payment is $500. And I'm gonna pay it off over 47 months, and I've paid $3,000 in interest. Now, if this was credit card debt and I had a 25% interest rate, now you can see that same $500 a month payment, it's gonna take me double the amount of time to pay off, 87 months, and I'm gonna pay $23,000 in interest. So I'm paying more in interest than the total amount of this loan. Again, that just highlights the importance of attacking your highest percentage rates first, avalanche method, get those down, and then start whittling down from there. Now, let me give you some tips for avoiding new debt. Again, debt isn't always bad. Credit cards are a fantastic tool for most people. And really what you want to be doing with credit cards is making sure you're paying off your balance in full every single month. If you're doing that, you're doing fantastic. You're not paying a dime of interest to the credit card company. That's the number one most important thing with credit cards. And how you do that, and how I actually did that personally with my first credit card, I got my very first credit card, I had a $10,000 limit. And this was back right when I was just getting out of college. I didn't have $10,000 to my name. I didn't know how to use it. And so I actually called my credit card and asked them to reduce that limit to $1,000. Now, this isn't the wisest thing if you're thinking about your credit score, but it worked great for me. I did it for about a year and a half while I learned how to manage my money and learned how to pay it off appropriately, because I had that cap of $1,000 that I knew I couldn't get in over my head and just into that snowballing effect of more and more debt at higher and higher interest rates that so many people in America get trapped in that they can never pay their way out of. So that's how I started. But again, most important thing, make sure you're paying off your credit cards every single month. If you can't do that or don't think you can do that, best to stay away from credit cards. Now, basic number 4, an introduction to investing. So there are countless ways and things that you can do with your money that you can invest in. I'm just gonna focus on really the ones people think of most often, which would be the stock market or retirement accounts. The earlier you start investing, the more time compound interest has to do its magic and to grow your wealth. exponentially. To prove my point here, let's take a super simple example of just a little bit of money invested over a long period of time and how those returns can be huge. We're here on the investor.gov compound interest calculator, just starting with an initial investment, even of $0 at only $100 monthly contribution. Let's say you're 20 right now and you have 50 years until you want to retire at 70. Let's do an interest rate of 10% because that's actually what the stock market has averaged over the last 60 years. And I hit calculate and it spits out this really great graph. So again, we didn't start with any massive investment, only $100 per month. And at the end of the 50 years, you've contributed a total of $60,000, and yet the value in your portfolio is $1.4 million. Now, what you're probably most interested in is what can you actually invest in? So there are stocks, and there are groups of stocks, which are often called index funds, mutual funds, or ETFs, exchange traded funds. Now, stock, best way to think about that is you can purchase a share of an actual company. You can go buy a share of Apple, and now you own one tiny slice of that company. And so you own a share of the future growth of that company, or you can share in its demise if it ever goes down. And if you own one of those other financial instruments, so mutual fund, index fund, really what that is it's a basket of stocks where instead of you buying 100 different shares of 100 different companies, you can buy one share of a mutual fund or an index fund, and now you automatically own a tiny little piece of a bunch of different companies. And so it really allows you to diversify much better than just going out and buying individual stocks. Retirement accounts, on the other hand, are actually very similar. They're typically investing in mutual funds and index funds, and employers will typically select from a series of those and allow their employees to invest in a number of them. But again, it's really the same thing that you're investing in. Those accounts typically do have a lot of tax advantages though, so make sure you do some research on which retirement account makes the most sense for you. One term you'll always hear thrown around is called diversification. And really what that means at its core is when you're investing, you don't want to put all your eggs in one basket. If I invest all my money in Apple and it goes down tomorrow, of course, very unlikely to happen, but let's say the technology industry goes down, all of my money is going to be exposed to that trend. Now, if I invested in a different company in a totally different industry, say oil and gas or something in pharmaceuticals, where if technology goes down, maybe it's unlikely that pharmaceutical industry will be going down as well. So that's how you can put a few eggs in one basket and then a few eggs in another basket, so that if one part of the economy is doing poorly, the other part won't be doing poorly. And so it'll start to manage itself appropriately over time. Again, best and easiest way to do that is through bundles of stocks, so mutual funds and index funds. Now, my biggest single pro tip here for investing and investing basics is make sure that you are in it for the long run. One of the worst things you can do is as soon as you start to see things decrease, you're pulling your money out and you're trying to time the market. Data is very clear on this, that people who try to do this, who try to time their market, actually hurt themselves way more than they benefit. So it's typically best to invest in a nicely diversified portfolio, leave it in for a long time horizon, and you'll see gains, you'll see ups and downs, but just ride through it. Now, for the fifth and final basic is setting financial goals and tracking your progress. SMART is a goal-setting framework that helps you set reasonable and attainable goals for your investing future. Now, what that stands for quickly is specific, measurable, achievable, relevant, and time-bound. Really, SMART goals help you turn vague ideas into actionable plans. So instead of saying, I want to save money, a SMART goal would be, I'll save $5,000 for a car by setting aside $500 a month for 10 months. So it gives you focus, accountability, and a clear path to success. And again, break these goals into smaller targets. If you want $5,000 for a car a year from now, break that down into a monthly goal. It's about $400 and some odd dollars a month. Break that down into daily, right? That's about $14 a day. Then think about, hey, if I need that extra $14, what am I wasting $14 a day on? Am I going out to eat every day? Am I, spending too much on this thing? And I can start to cut these things down and make it easier on myself to start achieving these goals. All right, so those are the 5 basic beginning tips to help getting you started towards your financial goals and teaching you those things that you didn't learn in school. And hopefully this gives you a better leg to stand on now moving forward into the future. Now, I promised you a bonus tip at the very beginning, and what that tip is pay yourself first. Most payroll systems and employees or banks have a tool which will allow you to take whatever income you're getting, set aside a certain percentage before it even hits your bank account, and push that off into another account. So this is a great way to start saving for that emergency fund, or to start saving for other sort of goals, whether it's down payment for a house or travel funds, whatever it is, where you can have two separate accounts that your money's coming into. So that way your main account is, you're already seeing that savings shaved off before it even hits there. And so you're working on that smaller account for your daily living expenses. It's a really great way to help you achieve those goals. So I really hope this was helpful. So thank you guys for watching. Make sure you smash the like button. Comment down below what sort of financial goals you guys have. What interesting things did you wish you learned in school around finance that you didn't learn? Share it with the rest of us. We'd really love to hear it. And make sure you click this video right here to check out what the best high yield savings accounts are so that you can start to build that nest egg that you have into the future.